Good morning, everybody. Welcome to our latest webinar. Today, we're talking about one of my favorite subjects, bridging finance, and specifically how it can be the unlikely hero of property transactions. Some of the comments that we had from registrations for today's webinar included, I'm looking forward to an update on current property criteria, and it's an area of business I know very little about, so I'm keen to expand my knowledge. Bridging is always a topic that stimulates the grey matter and gives you opportunities to solve problems that your clients may come up against. And I'm sure today will be no exception. On today's webinar, I'm joined by two gentlemen who are both very experienced in bridging finance, and I'm delighted to say they bring their knowledge and experience to share with us today. So I'm delighted to welcome Gareth Lewis, Commercial Director at MT Finance, and Michael Grant, Head of Sales for Bridging and Development for West One Loans. Morning, gentlemen.
Good morning.
Morning, Chris, how are you?
Yeah, very well, thank you. Thank you for joining us today.
Morning, Gareth.
Morning, how are you?
Yeah, good, thanks, mate.
So these sessions work best if we're covering off the topics that you, the attendees, want to hear about. So at the bottom of your screen, you have the Q&A button. So please use that to fire across any questions that come to mind or any scenarios that you've got on your desk at the moment, and we'll do our very best to cover them off for you on today's session. We have a packed schedule this morning, so without further ado, let's dive straight in. So to start us off with, gents, can you just give us a quick introduction, 2 minutes or less, just to let the viewers know a little bit about yourself, where your USPs are, and what you feel sets you aside from other lenders in the space? Gareth, do you want to start us off?
So I'm Gareth Lewis. I'm Commercial Director of MT Finance. I've been in the bridging industry since 2004, so a day and an age. As us as a lender, I think, look, everybody can talk about USPs, but I think USPs are related to the bridging sector as a whole, not necessarily lender specific. But I think the reality is its flexibility, commerciality, and common sense based approach to lending, which hopefully will come through in today's session. I think it's, everybody can say speed, but the reality is it's all about certainty, I think, especially in today's environment.
Yeah, very good point. Thank you. Michael?
Hi, good morning. So I'm Michael Grant, Head of Sales for Bridging Finance at West One Loans. Recently celebrated my eight years now here at West One, so a long time. So seen a lot of changes throughout. Just reiterate Gareth's points about USPs. I guess, look, there are many different areas in which we can say that we do one thing better than another, but ultimately it's down to the communication as all, and ultimately all parties involved are all motivated to come to the right conclusion and the right conclusion for the customer, which is most important. And that's kind of how I see the market really. Ultimately is just all of us coming together and just trying to do the right thing for the customer, which is the main thing here. So yeah, that's where we're at.
Excellent, thank you. And I've been at Crystal for 15 years, working in the specialist space, so commercial bridging development. And just when you think you've seen it all, there's always another case that comes up that brings something new to the table. So specialist finance is one of those areas that there's always something else to learn. There's always something else to pick up on and develop. And I think, both gentlemen have hit the nail on the head. It's about flexibility, it's about certainty, and it's about really delivering that outcome for the client. Especially when it comes to bridging, no one, very rarely will a client come to you and say, I really want a bridging loan. A client will come in and say, I've got a problem. I need to get to this point. I need to get from here to here. And it's the bridge that provides that solution to getting there. And there are lenders in the market that offer various products, various solutions, but the key is, can the lender deliver? And, the two lenders that we've got on panel today, we've got a long track record of working with both of you and getting that outcome and delivery for clients. So, Michael, how would you introduce bridging to a broker that might not have had any or much experience of it before?
I think the way in which we would look to introduce someone to it is understanding that, like you said, it's not something that someone wakes up in the morning and says, I need a bridge. It's there to provide a solution to a potential problem or a scenario that will lead to something which will be fruitful for the customer. Ultimately, we would always just introduce ourselves in the sense of we are well trusted. We've been around for years. We're authorised and regulated by the Financial Services Authority. And we have a good standing within the short-term lending market. And that's kind of how I would go into it. Again, it's about making sure that you know, the broker is well versed in terms of their knowledge and understanding to be able to kind of relay that to their customer, making sure that that is the right option for the customer. Ultimately, we need to look at all angles of finance, but ultimately we're coming down the route of bridging. Again, it's got to be the right solution for the customer. And I think that's key now. You know, I've been here 8 years. Gareth, you said you've been around for a long time, same with yourself, Kris, and we often see situations where people are shoehorned into a product that doesn't quite fit, because ultimately it could make you a quick buck, and that's not why we're here. We're here to make sure that the decisions are made correctly, and ultimately the right outcome is there for all concerned. So for me, it's just about giving that knowledge and understanding of what we offer as an organization, and again, how we can best help that customer to solve whatever problem there is in front of them.
Brilliant, thank you. Gareth?
Yeah, look, I think the broker market can fall foul of thinking a little bit with a blinkered view. I think the mainstream mortgage market and even some of the top tier specialist lenders can be very prescriptive in how they lend. And I think what a broker has to do to think about how to utilize bridging is think a bit more laterally. You know, it's very much, the sector is very much common sense based approach to lending. Ultimately, you look at a transactional scenario and you find a route to support it from that perspective, as Michael alluded to. The reality is, just because a mortgage lender wouldn't lend against a property type or a customer type doesn't mean that there isn't a home for it. And I think that's where a broker has to sort of then start to think outside the box. Just because a property doesn't or isn't considered lettable because it's got a pea green bathroom suite, you know, and needs some updating and modernising, doesn't mean that there isn't a home for it to be lent upon. You know, that's where bridging certainly comes into its own, where it starts to think about, okay, an asset has value regardless of what it looks like, feels like at that moment in time. Lend against that value. Consider why somebody would want to do that transaction. You know, is it saving the money? Is it making the money? Is it get them out of a hole? And then find a route to be able to do that for them by looking at the you know, the 4 pillars of lending: who the client is, why do they want the loan, what's the asset, and how our loan's going to be repaid. You know, I liken bridging finance to that old-fashioned, well, it was born out of the old-fashioned way of a bank manager understanding a client and the client's needs. You know, that's where bridging really sort of escalated from. You'd go into your bank, your high street bank, which obviously you don't do nowadays. You'd see your bank manager who'd be in control of lending, and you say, look, I'm looking to purchase another house. Haven't sold mine, but, you know, purchasing this other house is going to keep my other half really happy. Can I go ahead with it? And they go, look, I know you bank with us for years. Here you go, here's some money. And I think that's essentially what it is. It's just understanding the transaction.
Very good point. And I think with bridging, it's important to remember it's part of the solution, isn't it? It's not the whole solution. Because we put someone into a bridge, you know, a number of lenders will come in and say to us, anyone can lend money, it's getting it repaid that's the difficulty. So when we do put someone in a bridge, the key is, how do we get that redeemed? You know, is it going to be refurb and sale? And then how's that progressing? Is the property going to be on the market? If it's refinance, how possible is that refinance going to be at the end of it?
I think as well, Kris, that is something that has become more and more prevalent in today's market. I mean, you know, going back years and years ago, it used to be a lot about the asset that we're lending against as opposed to who we're lending to. And as the market has suddenly grown, a lot more lenders have come into play. You know, we have to be responsible in terms of understanding it's more than just all the property is set in, you know, in Mayfair, wherever it is, and it's this trophy asset, and it's a lovely property, we want to lend on it. But ultimately, there's more to it than that now. We have to look at, like you said, who we're lending to, the story around what that customer looks like, their journey to get to that point. And again, like you said, you touched it, we'll probably touch on it again later, about the exit routes now is becoming more and more important in terms of where we are. And maybe you look at it and think from a bridging perspective as well, the reason why I'm bridging is because I don't have an exit there at the moment anyway. So this is the reason why I need to do this. But it's a catch-22 scenario situation where ultimately, if we're looking at it from a risk perspective and being commercially minded at the same time, we have to be mindful that we need some kind of exit there to realise that if things weren't to go as planned, what then happens in that scenario as lenders, and I'm sure Gareth will share this sentiment as well, we don't want to be in a position where we're having to repossess properties. We're there to help and offer solutions for customers. So again, touching on the point there about how the journey is now, and also the importance of not just putting them into a bridge, but ultimately the back end of it as well.
So Gareth, we've seen increasing pressures on the term side of things in recent months. Have you seen any impact on the bridging side?
Yeah, look, I think we don't live in our vacuous bubble in bridging. We are certainly impacted by what's going on in the greater mortgage world and the financial world as a whole. I think the fluidity that bridging affords and the nature and the structure of funding that supports it from that perspective as well allows a great deal more flexibility. But you always have to look at what's a worst case scenario. You have to look at forward forecasting when it comes to interest rate environments, the pressure points that come on property as a whole. So yeah, look, I think it'd be foolish for anybody to turn around and sort of say, no, we're not impacted whatsoever. But I think where bridging finance really, again, comes into its own, like we've touched on before, is that ability to be fluid and be understanding of the market environments. You've seen product diversification. You've seen people look at the marketplace and go, okay, well, where are we going to be in 12 months? Let's have an educated assumption. It's not a guess and it's assumption. You're looking at forecasting from that perspective to say, okay, where's our risk? Because as you quite rightly say, lending money is risky, and there's no risk that isn't overcomable from that perspective, for want of a better expression. But you have to be forward thinking when it comes to that. So there has been pressure without a doubt, but we can deal with it probably a little bit more smoothly and with a little bit less fuss.
So the relationship on a bridge in a perfect world is 12 months or less, isn't it? Whereas on a term, you're in for 7 years plus normally on those.
But interestingly, we're seeing, just picking up on that, we're seeing a lot more people looking at greater terms than 12 months. Okay. There is an element where you talk about solutions. Bridging finance, a retained interest facility for 2 years can give somebody that freedom to navigate this higher interest rate environment that we currently find ourselves in, especially if you go back sort of 2-3 weeks. Okay, there's been some settling in the swaps and the capital markets, which has given us, access to better pricing when it comes to fixed rates at the moment. But the reality is you're still in a volatile environment, so that you could look to do a 2-year retained interest facility, put yourself in a position where you're paying circa 10%, which is not hugely over where you're sitting currently on mortgages, but give you that flexibility that in say 15 months time, when everything is truly settled down, you can then just refinance without penalty. Whereas if you put yourself in a 5-year fixed at this moment in time with a 5-4-3-2-1 on your ERC, does that make sense in 15 months time if you've got a 3.5% interest rate environment?
Good point. Yeah, Michael, have you seen pressures on the bridging side from a financing point of view?
Yeah, I mean, look, we are in a difficult moment in the economic climate in terms of where we are. It seems to be stabilizing a little bit. We've all made relevant adjustments in terms of pricing and where we see things happening, and as Gareth mentioned, you can make assumptions for what the next 12 to 24 months are going to look like, and then ultimately from our perspective, and most of the market now have maybe shifted their pricing somewhat to reflect that. I think off the back of that, we are now starting to see customers realize that their expectations of yesterday are not what they are today. Whereas, maybe a few months ago, we'd be putting out a set of terms at X price and ultimately, 10, 11%. And, we're getting feedback, oh, well, that's way too expensive. I can get it for this. And it's like, well, okay, well, fine. I mean, this is where we are currently, and we're not going to kind of put ourselves in any financial risk or danger in terms of going out and trying to just, reduce our pricing for the sake of it. Look, I think we've been financially blessed over the last 4 or 5 years in terms of a pricing perspective, because there's been so many of us in terms of lenders out there. It's been a race to the bottom, and it's been dangerous, really, some of the pricing that I've seen on certain deals. And now we're getting to a point where the realization has set in is that this is where we're at in terms of the cost of what the deal's going to look like. But the one most important thing for me, and I think, you know, Gareth might echo these thoughts, is you know, having strong liquidity, having assurances of funding is very, very important. The amount of times that you see something that you can't quite get there because it's just too low, and then it comes back a few weeks later and say, oh, by the way, this hasn't quite worked out for me. I've got a valuation report, and would you look at this deal now? So you know there are certain movements in the market that we've seen. Look, at the moment, I think the market's still buoyant, it's still busy. Come next year, there will be opportunity for a lot of people who have the potential to maybe look at still buying stock, whether it be land, whether it be residential property, auctions, etc. Because I think the way things are going, the struggle to be able to refinance is becoming more and more real now, and it's becoming difficult, and therefore people are having to forfeit certain situations. There's going to be a lot of distressed purchases in the market, I feel, and there's going to be a lot of deals out there that people are going to try and capitalize on. So that's potentially where I see it moving forward. But from a pricing perspective, look, we've moved accordingly, and I think we are where we need to be right now, and people are starting to realize that that's the correct move.
Kris, if I may just jump in, you know, Michael made a really good point that the reality is, as you know, you talk about brokers who haven't experienced bridging, you know, in your last question, how do they get into bridging finance? I think they have to be mindful at this moment in time. It's very easy to do bridging finance when everything's going in the right direction and it's a really buoyant marketplace, and it's a low interest rate environment where there is very much a consistency when it comes to pricing and liquidity availability in the marketplace. I think where a broker needs to be very mindful at this moment in time is, don't think you can just do it just because you've been on this webinar today. I think you have to look at turning around and utilizing experience in your favor to support you within that bubble, because one person or one lender could turn around and say, yeah, I'm lending money at this moment in time, as Michael said. But the reality is, you know, depending on the strength of their funding, the diversification of their funding, I think, is a really critical thing as well. You know, not just being beholden to one funding vehicle, because we have seen some of the funding side that's been propping up bridging finance fall by the wayside recently. So you could go down the merry dance of thinking you're getting a bridging loan through a lender at this moment in time, and then suddenly fall foul to the fact that they haven't got the liquidity they thought they had, or something's been pulled from them. So, you know, I think utilizing experience like yourselves, you know, at Crystal to sort of sense check the availability of that, because everything looks really good, you know, from a marketing perspective, and everything looks fluffy when you see these things. But the reality is you don't always understand what's under the hood on that side of things. So I think it's very much a case of being mindful of who you partner with as well.
Yeah, very good point. And when things get tough, a lot of people can show their true colors at that point. And I think we've certainly had two deals in particular. One of them where the lender increased the rate on the offer on the day of completion. Everything set, legals all signed off, and then the lender said, actually, due to a change in pricing this morning, we're now putting this rate up. And it went up not unsubstantially either to the client. The client obviously wasn't best pleased, because everything was done at that point. It wasn't like it was early in the process. It was literally an hour before funding that the rate went up there. So again, from our point of view, you look at whether that's a deal that a lender you want to be working with moving forward. And secondly, we had a lender a little while ago now, post completion, the client was hit with on redemption, the client was hit with a number of fees that weren't included in the original offer. Lender took quite a substantial amount of time to get back to the client and explain where that was in the 26-page offer document that they've been sent, which clause actually related to that. And again, it's not just about looking at the shiny website and the rates that they're talking about on day one. What's that experience like for the client? What's that journey like? And is that a process that you want to be involved in? So we make sure the lenders we're dealing with, we're constantly monitoring performance, we're constantly monitoring the customer journey, the outcomes that people are getting, because it isn't just to put them in and leave them. It's a life cycle of that transaction.
Yeah, of course. Yeah, and as well, Kris, it's you know, the service that you guys offer, that the problem, I guess the challenges that you have, not a problem, sorry, is ultimately you have others out there who are saying something completely different, and the customer is left in the middle here. And ultimately, from a customer's perspective, it's like, well, I need to borrow X amount, but these guys are telling me one thing, I'm being told something else from someone else. This looks a lot cheaper than this looks, but ultimately, if you strip it all back and you look at it, the advice that you guys give and the experience that you have, it completely outweighs someone telling you that I was going to be X amount. And that's the challenge that you're facing. And ultimately, look, sessions like this are good to allow brokers to come to you to obviously understand and educate them as to how it works. And like you said, Gareth, as well, anyone can kind of go out and put someone in a bridge, but ultimately it's about the back end of things and how you look after that customer throughout the whole journey. And that is really, really key, especially from us as a lender and yourselves as well, ultimately knowing that you've got that journey from cradle to grave, that you've got your hand held all the way through, understanding the process and how it works. I mean, you know, look, as I said, I've been here 8 years and you're learning something new every single day. And like you said, 15 years yourself, Kris, I'm sure there's things that come up that you haven't known of or you need to learn and you go through. So we're all educating ourselves as we go through to make sure that we're making the right decisions as we carry on.
Yeah. Sticking with you for a second then, Michael, we touched on pricing. Have you amended criteria at all in light of recent changes?
Yeah, just a few changes, which I think is in line with the market. I mean, you know, from a lending perspective, if we're looking at acquisitions, you know, we're capping out about 70% loan to value as opposed to 75. I mean, on a referral or on a really strong case, we may look at going to 75, but you know, where we feel comfortable from a commercially minded making decision is 70% feels like the right number at the moment in terms of purchasing. If we're looking at refinancing, we're probably going to be around the 60-65 mark again. Those are the fundamental changes from a pricing perspective. Pricing, as you can imagine, has gone up slightly, so around about the 10% mark, as Gareth mentioned earlier when he was talking. So we're pretty much there or thereabouts. I think when it comes to pricing, it's much of a muchness, right? I mean, like, you can go and see a rate at, you know, 8, 7.5%, 10%. There really isn't much in it, and maybe it's a psychological barrier that customers need to get themselves over, and some brokers need to also get themselves slightly over that barrier or hurdle of understanding, well, I've got something at, you know, 9.5% or something at 10.6 or whatever it may be, and you're like, well, okay, slight difference there, but maybe there's other areas in which we can obviously make sure that we are ahead of where we need to be. And one of the things that's very, very important, we always touch on it, is service, is flexibility, is assurances of funding, is being you know, liquid as a lender. Those things are the key things that we need to be driving forward when decisions are being made in terms of where you're looking to place the case with said lender, for example. So that's kind of the important thing for us. But ultimately, look, I think there is a lot still to be learned in terms of where the market is today and what's going to happen tomorrow, and we've all got to be prepared for that.
Thank you. Gareth, any changes to criteria from an MT side?
In reality, no, we haven't actually addressed anything when it comes to criteria. We've never been overly bullish when it comes to loan to value anyway. You know, we're not a lender that's seen 75% or 80 or 85 as some lenders sort of did, you know, not too far ago. But the one thing that we are doing, and the one thing we're talking about to the underwriters, is very much looking at risk and looking where you mitigate your risk. So if you have got a loan to value that is 70% loan to value, okay, what's the exit? How viable is that exit? What's the track record of the borrower? You know, that kind of stuff. So you're just maybe asking a couple more questions, and you're trying to sense check things a little bit more, to feel that you're comfortable still being at that sort of loan to value. But in reality as well, one of the things I'd say about loan to value and that leverage point from that perspective is ultimately the market isn't all at 70, 75. You know, the average loan to value that we see in our lending is somewhere in the region of sort of 56% loan to value. So the risk points and pushes towards the loan to value side of things are few and far between. You know, the bridging trends data that came out recently was something in the region of 59%, I think, for Q3. So again, that's even market feel. From that perspective, that's not just data from us, that's originators within the space. But again, I think it's what a good lender does in the background, which is the key fundamental. So, you know, lending money's risky. It's all about mitigating risk from a lending perspective. So your underwriters are tasked with looking at the deal, looking at who's behind the deal, looking at the asset you're taking as security, and then looking at how viable is the exit, and then, you know, that could be strength of term as well. For instance, Kris, you know, there's been a lot of talk recently where, you know, some clients have been put into lending where the term isn't appropriate. You know, refurb and renovation at this moment in time, for instance, is taking a hell of a lot longer than it used to. Whether that's been sourcing materials, delays in certain other areas in terms of access to materials from that perspective, and builders being inundated with work as well. So, you know, you've got to look at forward forecasting when it comes to a loan as well.
Yeah, that's a very good point. So sticking with you for the next one then, Gareth. So bridging is often used where speed is the main driving factor. How have completion timescales been holding up recently?
Look, all the data is pointing towards that your completion experience is sort of elongating slightly. I think that's pressure points that you find on the marketplace as a whole. You know, there is a lot of transactional flow that's still going through where solicitors are involved, and that can cause delays from that side. I think you've also got an element where clients are dragging their feet a little bit when it comes to getting a deal over the line, because with this uncertainty around the market and the volatility around the marketplace at this moment in time when it comes to interest rates, and also then the potential knock-on impact of price and value of property, we're finding there's a couple of instances of late where you've got clients who are just sitting there going, I'm sitting on the fence whether I want to do this at this moment in time. So you've also got that drag. You know, but for my consideration, you know, when I first got into bridging finance in 04, you know, it was very much a speed orientated transaction, because there was something underlying within that transaction that needed to be done quickly and they couldn't get it done through the high street. I think the evolution of bridging as a whole is it's a facilitator now. You know, it's a liquidity tool. It's being able to lend where the high street in the market, the mortgage market doesn't support, whether that be refurbs, renovations, you know, asset type, the transaction behind it, you know, what the client's actually truly looking to do. So the need for speed for me is a less relevant point now. It's more about that certainty of liquidity that comes more into play these days, I would suggest.
Thank you. Michael?
Yeah, and you know, a couple of really, really good points there. Speed is often one that's always talked about bridging. I think that's something which is yesterday's news in terms of speed. You know, that traditionally, when you're looking at bridging finance in your mind, or someone who hasn't transacted bridging, or their mindset of bridging is you can get a loan in a couple of days, it's quick, it's easy. And now we're finding that bridging loans sometimes take as long as a mortgage, or you know, for the same reasons that Gareth has mentioned, is customers are in a position now where they're thinking to themselves, have I made a knee-jerk reaction here? Do I need to go down this specific route? And it goes back to the first point of, no one really goes into a bridging loan because they want a bridging loan. It's there to act as a solution to a potential problem. Or if you're looking at on the flip side, where you've got, you know, property professionals, landlords, developers, there are reasons as to why you're looking at a bridging loan, because it buys you time, right? So, you know, there are certainly a few different elements of a customer that you've got to look at. So if you're looking at a customer who is a seasonal purchaser at auctions, and ultimately speed is what they're looking for, right? And therefore there's the motivation to get the deal done from the initial point of, you know, putting your deposit down to the point of actually completing your transaction. So therefore speed becomes important and is relevant. So it's about motivation, right? I mean, you know, from a lender's perspective and your perspective, Kris, you know, we're all motivated to get the deal done. So therefore we'll push as hard as we can, but ultimately the key drivers are, you know, third-party influences that we need to be mindful of. So valuers, lawyers, and then ultimately, most importantly, the customer. How motivated is the customer to get this deal done? One of the things that is a massive bugbear of mine when I'm looking at inquiries and cases is, right, we've got this really urgent case, it's titled as urgent, and then you look at the body of the inquiry, it comes back, you know, you get your terms out as quickly as you can, you agree the deal, it comes back, and then the key question you ask is, when does the customer need to complete? ASAP. I mean, what does ASAP look like? Gareth, I can ask you, what does ASAP look like? Kris, I can ask you the same question, and you probably will give me two separate different answers. It could be yesterday. We start the process and all of a sudden it's taking a considerable amount of time to get done. When you've got an inquiry where you've got someone who gives you a designated completion date, we can all get it done within that relevant piece of time. So I think the question is one of those where you've got a certain customer who falls into the speed bracket and say, yes, you can get things done. You've got another customer who is ultimately looking at this as potential backup to their first option. And then you've got another customer who is simply just kind of looking around the market and seeing what their option is, about optionality. But look, for us, speed is important, but again, it's not going to be relevant in all certain situations and circumstances.
Yeah, very good point. And we're still, the key for me is we're still subject to solicitors. That seems to be the biggest delay from our side. The fact that a case will go into a solicitor, maybe an inexperienced solicitor when it comes to bridging. They might have 20 cases on their desk. The bridging one goes to the bottom of the pile because they've got the ones they're familiar with that sit there on top. So one of the messages that we put out to people is, if you are looking at an urgent bridge, can your solicitor complete as quick as the lender can and as quick as we can get this moving? Because if not, it doesn't matter how quick the lender wants to do it, it's going to get stuck at that point.
It's a very good point, Kris, because and forgive me, I can't remember the percentage, but post-pandemic, the volume of solicitors and conveyancers that left the marketplace was quite astronomical, which means there's such, when you've condensed a resource quite significantly, the pressure points that then goes on there is quite high. And obviously for a new conveyancer to come through, a younger blood person to come through, that takes a period of time. So whilst you've got a percentage that have disappeared from the market, and the same could be said for surveyors as well, there then becomes a really big pressure point that gets placed on that. Because also ultimately from a lending perspective and a borrower perspective, you also want to have experience. You don't want to just turn around and give your conveyancing to somebody who's just fresh out of university, or again, a valuation side of things. That those type of transactional flows need experience.
Yeah. Apologies if fire alarm test in the background there. There's nothing serious. I'm fine to be here, don't worry. There are certain things that we can do from our side as packager and broker to give cases the best chance of moving forward. One Michael touched on there was, if there is a completion date, let's make sure everyone's aware of it, so we can all make sure that we're targeting that point. Yeah. Making sure that we understand the transaction in full. We've seen a big increase recently in cases that are changing post-application, maybe from sole to joint borrower, or exits change from being sale to being remortgage, and then additional questions come up off the back of it. So let's make sure we all understand the transaction nice and easily. And probably the easiest one is just make sure that when a question or a form is asked for, that it comes back complete. Again, when it comes to deposit, the lender's asking for proof of deposit, show us where it is, put the deposit there, give a bank statement for it. The amount of times we get multiple phone screenshots of things that come through that are just going to trigger further questions off the back of it. So whilst it is a bridge and it is meant to be quick and it solves problems, it's still a mortgage. At the end of the day, the lender's still going to ask questions and still going to want to see certain bits. So there's bits that we can do to give that the best opportunity of going through.
Definitely.
So Michael, jumping onto you for this one, have you seen any change to regulated or non-regulated split of business recently?
For us, we probably do about 25 to 30% of regulated business as a whole. And at the moment, not really too much. I think the difficult thing now is ultimately people are coming to a point where we're going to see a lot more restructuring of finance, because ultimately, the mortgage market, they have products been moved and shifted and removed. So it's going to prove difficult for a lot of people trying to refinance. So that's what I maybe going into Q1 and Q2 of next year, we may see a bit more. But ultimately for us, as I said, 25 to 30% of our business is regulated. So we've not seen a major change in it. I think one thing that I have found is we probably may not be, one of those that a lot would go to for the regulated space as such, in terms of where you are pricing and loan to values, etc. So for us, not a huge amount of difference in terms of what we're looking at.
Thank you. Gareth?
Look, I think seasonality plays into this at this moment in time. But historically, we've found, and I found in the bridging space, that the regulated market does tend to pick up in after the summer, because there's this heightened awareness that they want to get a transaction complete before everybody breaks up for Christmas. There's that necessity there that these dates play heavily on people's minds. whether it's the 31st of the month or the 1st of the month, it's still a day, but also then the historical side of things that pushes everybody to want to get it done before we turn into the new year. So yeah, we've certainly seen a seasonal uptick on that side of things. I think, again, it goes down to the fact as well that, the reason that the bridging market works so well in the regulated sphere specifically is because, demand outstrips supply. And if you are looking to buy your retirement home or go up the ladder and be in the area that you want to live in, unfortunately, you have to react quickly to the opportunities in terms of purchasing property. So that's where bridging can come to its own, because it can look at that whilst you're waiting for a sale to come through on your existing residence to take that opportunity. And it is still, a big relevant factor that, your forever home, you're probably got, you're certainly not the only person that wants to buy that forever home, especially in the right location, or that new family home where you're close to the good school that you want to get your child into, for instance. So these things do become heightened at this moment in time. And again, it comes down to that seasonality factor on that as well.
Gareth, do you think you'll see a lot more maybe downsizers now in terms from affordability perspective moving forward? Because ultimately now you've got, we see a lot of people who, older generations who've got these massive big 4 or 5 bedroom houses, and ultimately it's just them and a partner, and you may see a lot of more of that now from affordability perspective.
So spot on, and I think that's the thing, isn't it? Ultimately, if you're rattling around in a big house where you've got a fuel bill to pay to keep it warm, and it's only you two, and it's a 5-6 bedroom house, what's the point in being there necessarily? I think it's been seen in other sectors as well. Interestingly, I was having a conversation over the weekend with somebody who's in the car finance world. And they're seeing a lot of people who, have been sitting around in these big 4x4s, SUVs, who are sitting there going, well, actually, I don't really need this. It was more of a status symbol. I'm actually going to downsize my car, whether that's a midlife crisis downsize or to a sports car or something different. But they're sitting there going, why do I need a Range Rover sitting on my drive when I don't use it, type scenario. So the same factor applies, in all walks of life. I think people are starting to be mindful of the impact of what's happening in terms of the interest rate environment, full stop, and I think in terms of the cost of living environment that we find ourselves in. I think, taking that point as well, if I may, Kris, the reality is where we sit now, I think us as financial intermediaries, whether from a lending perspective or a broking or packaging perspective, we now have a challenge on our hands to re-educate people, because ultimately we've been sitting in a very benign low interest rate environment where you knew where interest rates were. They were very low and in reality unsustainable for the period of time that it's been there. What we're now seeing is obviously interest rates are going up, and there's a whole heap of people that have never seen it. They've never known an interest rate or base rate being above 1, for instance, and they're now sitting there in an environment where it's 3, and everything's saying it's likely to go up from there. But you go back to 2004 in that region when I purchased my first home, my 2-year fixed rate was 5.5%, and that was a good deal. So we have to re-educate the consumer that actually just because base rates at 3 or 4 even potentially come mid next year, that in reality is a good interest rate environment. We're not talking 15s. You could be in Argentina and it's 75. These are the things we have to re-educate people to.
I think the expectation was there, wasn't it, that it would be a gradual increase, that we'd slowly come out of what had happened over the last few years, whereas instead we've taken a leap. Instead we just hit people a lot harder in a shorter period of time.
Yeah, but you know what? My personal opinion, I think that leap probably helps a little bit as well, because you get to the point where you need to be quicker. And okay, it causes some angst and it causes some hurt, but as we've seen, that volatility, and it depends what happens on Thursday as well, but that volatility that came out and pushed everything up so significantly has impacted for a month and a bit. And now we're starting to see that softening, and we're starting to see the swaps come down, and we're starting to see base rates and interest rates become more aligned. Yes, it was it caused a lot of angst and a lot of pain for everybody, you know, on this webinar. But the reality is that it was something that needed to happen, and possibly it's happened quickly, yes, and it's caused some pain from that perspective. But I think actually it could be considered as a good thing as well. I'm a positive man.
That's what we need. I think many of us will still be having nightmares about the end of September for years to come.
Yeah, look, I still wake up in a cold sweat.
But a positive cold sweat first.
Yeah, exactly.
I'm going to jump onto some of the questions that have come in live. We've had quite a few come in, so please feel free to keep sending those across. We've got a couple of scenario-based questions. Current rental property tied up with a high street lender. Broker wants to convert the garage into a living room. What would MT or West One be looking at from a lender point of view there? Anyone want to take that one first?
Gareth?
Yeah, look, we could certainly have a look at something along those lines, depending on where they're leveraged on the first charge. So you could look at a second charge facility to help them convert that garage and ultimately get that living space and inherently add value to the property. But again, it would be down to what loan to value that current mortgage is sitting at, whether that current lender would consent to a second charge, and then what the works are that are needed to convert that garage into livable space. You know, ultimately, the premise of the refurb and renovation is to add value. You know, you can't do it if you're not adding value, because, you know, it doesn't really make sense. But you would expect to see more, you know, more value added to a livable room rather than necessarily a garage.
Yeah, and just to add to that, and just make sure that there's no planning stipulations that prevents you from doing what you need to do. Yeah. Again, that's something that obviously from an underwriting perspective and legal perspective, we can obviously make sure that's fine. But and again, as you said, consent from the first charge mortgagee, it's something that certainly is going to become more and more apparent with a lot of people now, just trying to utilize what space they have and add value where possible, because if you can do that, then, you know, give you that ability to actually increase value in your property. Whereas now in the market today, we're probably seeing house prices drop slightly in line with where we are. So yeah, certainly something that we can also assist with on that basis. But again, just having a look in terms of, as Gareth has rightly said, where you are with your current lender in terms of loan to value, making sure you've got the relevant equity available in order to actually enhance the value, and ultimately everyone's a winner thereafter. But importantly, again, goes back to the first point that we made at the very start, the ability to be able to refinance once the work has been done.
Yeah, perfect. Thank you. So Shailesh Kumar, that's one that you can send across to us from there. Both lenders would be happy to take a look at that, given the conditions that we just mentioned there. We're also seeing more buy-to-let landlords talk to us now about potential EPC issues, and maybe pulling some capital out of their properties in order to maybe pull out one property if they've got a portfolio, in order to refurb a number of them to achieve relevant EPC targets, either to go after green mortgages or to stay in line with regulations moving forward. So there's a number of opportunities coming up for buy-to-let landlords that might lean towards bridging finance.
Yeah, definitely. I just on that point, Chris, you know, I was doing some analysis of data that was coming through from the UK Finance, and the average loan to value of a refinance on a buy-to-let this year has been somewhere in the region of 62-63%, which means there's an equity slug there that can be utilised in those instances. So you quite rightly say, if you've got a portfolio of properties, there's an element of debt equity there that you could utilise to start to get ahead of that curve when it comes to the EPC issue, that I think is people need to start considering now, because there's going to be a relatively huge impact that had on this. You know, I think it has to be a C for new lettings by 2025, which is going to come around very, very quickly. Yeah. And I think, you know, there's probably some work the government needs to do on this still as well, because I think the true impact of this is yet to be seen. You know, so I think if you can start looking at it, it's now looking at that portfolio, take a second charge over a number of different properties to help fund that. Again, you're going to add value as well in theory, because it's going to be a more lettable property, or it can be let, whereas some others might not be able to be let.
Thank you. We've had a question in from Atif, a two-part question. So what impact would the recession have on pricing and liquidity in 2023? And the second part of the question, clients that took bridging loans in the last quarter might struggle to refinance due to the economic climate. How will lenders look to deal with those transactions?
Look, I think in terms of a recession and where we see the market going, we as lenders and Gareth, I said, we forecast ahead. We look at the likely outcomes and scenarios as to what will happen. Hence why there's been a shift in pricing to accommodate and reflect in that. Look, there are going to be situations whereby refinancing will become tricky and difficult, and it goes back to that level of communication, Kris, where you're holding the customer's hand from putting them into a facility at the start, and then 9-12 months down the line when you're looking to refinance. And one thing that we pride ourselves in is that level of service that we have right through the process. So once we've completed a loan, we're not just going to say, well, thanks very much for your business and wish you the best of luck. We are in direct communication all the way through to make sure that ultimately at the end we can help and support our customers. And we are a lender that likes to think that we can do that. And ultimately, I think it goes back to, once you're in that position, you are communicating and aware of the pitfalls that may lie ahead because of where the market is. So we'll always try and find a way to, if we can, refinance, maybe extend if we need to, or is there other options of maybe does the customer have additional security that we can look at? So we definitely like to give options. And again, that's probably the thing that I would say is just making sure that the level of communication is there so we can have and reassess and look at the situation later on down the line. So yeah, it's a difficult one, but look, it's going to happen to quite a few people, and we are starting to have conversations early on in the piece to making sure that we can offer the right support to our customers.
Thank you. Gareth, anything to add to that one?
Yeah, look, I think to answer the first point of the question, we've already seen it. We've already seen some liquidity or that's been available in the marketplace to prop up some of the lenders has started to dwindle. Their appetites have changed from that perspective. So we have seen that funding has been pulled. I think from my perspective, the key thing for you as an individual to look at is look at the strength of that lender, how long they've been around. As I go back to the point we made earlier, I think diversification of funding is a very, very good thing. You could have the best funding vehicle in the world that supports you from a lending perspective, but if that one funding vehicle is the only one you rely upon and they suddenly turn around and go, yeah, we're out, we don't want to be in this game anymore, you're falling by the wayside very, very quickly, and you're then in a position where you can't support your brokers and your clients. So having that ability to diversify your funding and your capital stack is key and critical. Look, the reality is, we have to support the borrower. Ultimately, at the end of the day, no lender should be in this to profiteer on bad situations. I think ultimately, again, it goes down to that lender choice. A lender should be there to support a borrower. But the one thing I would say to any broker out there at this moment in time is it's very easy for clients, and then sometimes their brokers, to forget about the situation and bury their head in the sand. A good broker will continually be in dialogue with that client through that process. Even if the sale was exit, which you're not going to have a direct impact on, having that conversation with that borrower, a couple of months into the loan, a third of the way through, whatever it might be, and say, look, how are you getting on with that sale, for instance? Because there's an opportunity there. If the sale starts to get sticky and they can't get out from that perspective, where's the opportunity there for them to support that borrower, whether that be a refinance, whether that be looking at an asset recapitalization if you've got a portfolio. There's a number of different things, but don't ever bury your head in the sand and think that everything will be all right. And then finally you get to the end and the knockings, and you're ignoring people's calls, people's emails, and people's letters. That's never going to benefit you in any way, shape, or form, because a lender then loses confidence in you as a borrower.
Yeah, a very good point. Thank you. Question that's just coming from Brian. I have a client that may require an agreement on bridging finance to purchase a buy-to-let. How long in general are agreements valid for?
So ours are, an offer in principle is valid for 30 days. But obviously if everything's transacting through, then obviously they are more open-ended from that perspective. So as long as, the case is moving, you can get more than that 30 days. But if it's just an offer in principle that's gone out and nothing's happened on it, for us, it's 30 days.
Thank you. Michael?
Yeah, I mean, I guess what we're talking about, just initial terms going out in terms of, agreeing a deal for us, it's there for like about the same 30 days. It doesn't necessarily change. I think what would change if we've got a set of terms or an offer out on a bridge, and it takes longer than that, then we'd naturally review the case on its own merits at that given moment in time. I guess the point that's been made there, and I've seen this quite a lot recently, is, you know, we issued terms on a deal 2-3 months ago at a certain rate, and then lo and behold, we had the broker contact and say, oh, by the way, that offer that you gave me, they now want to go ahead. So we looked at it, and it's about 3-4 months had passed. I thought, well, we're going to have to relook at that and revisit it. So for us, as I said, it's about the same. It's about a month or so. It's not gonna. There's nothing really set in stone in terms of the offer will materialistically change at that point. Once we get the paperwork in and go to legals, pretty much, you know, stay as we are unless there's any materialistic changes via third-party influence valuations or something comes up at legals that we've not been aware of. But offers generally don't change and won't change for us. So that's where we're at.
Thank you. Yeah, we've seen a rise recently in people applying for a bridge from the outset to be a backup option. So they're telling us now that the plan A is they're selling this property in order to buy the next one, but they want the bridge there just in case it doesn't go through. Historically, it was terms that they wanted for that and nothing else. Now we're seeing them actually pay for valuation, go through the whole legal process, and then just sit there almost ready to fund just in case it's needed at that point. So it's yeah, interesting period at the minute.
Yeah, for sure.
So Neil's asked a question. What are the top 5 reasons for a bridge? I'm sure we could probably spend a whole webinar on this one. Michael, do you want to take a couple?
Top 5 reasons for a bridge. I think, look, I guess reason number 1 is solving a problem to a solution. So, and that could be, you know, we could expand on that and probably have 5 reasons for that within itself. Look, if it's a purchase, then option, it's about getting it done quickly and making sure you complete within the timeframes that are there. If you have a situation whereby you've got an option on something that you're buying, then it's about making sure that whoever you're going is going to have that assurances of funding to a point that we can't, myself and Gareth and anyone else who speaks will never sit here and guarantee something going through, but we can do as much as we can within the parameters that we've been given and ultimately get stuff done. But yeah, I think the first thing, as I said, it is going to be getting it done quickly from, let's say, from a you know, a committed and exchange purchase is the first one I would say most importantly.
Okay, Gareth?
Look, 2 I would suggest on regulated would be the chain break scenario. So looking to purchase a property whilst they're waiting for their existing property to sell. Certainly, you know, that's a very classical bridging scenario that is still there in the marketplace today. I think, again, on the regulated side, we're seeing more and more sort of heavier refurbs. So completing a self-build, for instance. You know, there's a lot of instances where they've turned around and they've started a project, they've got it to wind and watertight stage, they've tried to get normal funding for it and realised actually they can't, so they need to go down that route of you know, supporting via bridging finance. I think, again, when you take the non-regulated environment, again, refurbs, renovations, so lending on a value of a property that is currently unmortgageable, I think is a key element from that perspective. So, you know, I go back to my pea green bathroom suite that, you know, is very art deco and retro these days, but, you know, valuers generally don't seem to think that it's a lettable state. And, you know, conversions, we're seeing still seeing a load of those coming through. So commercial into residential, small office block into flats, that kind of stuff. But again, the key element, you know, as Michael said, and we've said along the way for this is it's that that bespoke funding solution. The key element of why somebody utilizes bridging is a solution. It's a solution to something, whether that be a need for speed, if that was the case, or you know, there's a quirkiness to the security, or there's a quirkiness to the applicant. It's just that common sense based approach to lending money.
Okay. And just one other wing, time as well, just buys someone time. So if you're looking at commercials or land or something with that, for example, it gives the optionality of time for an individual in order to acquire an asset to allow them to do what they need to do before the onward kind of goal and what they're trying to achieve. So we often work with a lot of developers who are acquiring land for one reason or another and maybe want to, you know, go through planning. That's very, very important. We see quite a lot of that, and then we can look at the exit at the same time. So that for me is what we see quite a bit of as well, where you've got someone who wants to amend planning, add value, is probably one within its own right as to why you would potentially go down a route of bridging, is to find a way to add value and to add value in terms of what you're doing moving forward.
Thank you. So Neil, so 5 points that have just been raised there then. So first, a property that's unmortgageable. Secondly, we're looking at speed. Thirdly, chain break scenarios. 4 would be a heavy refurb or a conversion. And then 5 would be to buy time for a transaction from there. So
can I throw another one in there?
Yeah.
Sorry, because we could go all day.
Yeah.
I'm going to go
capital raising. So actually, we talked about that liquidity element where there's a slug of equity that's unused. I think that's a big thing that people need to sort of get their head around. You know, if an average loan to value is low, then obviously there's a capital raising element there that you can put towards business purposes, refurbs, renovations, or a whole heap of things.
That's probably happening a lot more now, Gareth, isn't it? Definitely people who are looking at ways to try and just pull some more money out.
Well, just looking at the business side of the world, you know, you talk about all those Siebel's loans that have got to be repaid at some point. You know, if the business hasn't been burnt already, that means they've got their business back on track, which means they've got a debt to pay. And again, there's an element there that you could look at that side of things.
Yeah, excellent. Thank you. So there's your 5 plus an extra bonus one now. So thank you. So we're running a little bit short of time. So jump into some examples. So can you give the attendees an example of a recent case or two which you feel really showcase how bridging can be the hero of property finance? Michael, do you want to give us one to start with?
Yeah, I mean, we've a scenario that we looked at where we've helped a developer purchase a site. They were going through some changes within planning, some amendments before we looked at the ability then to refinance and provide them with development finance to build out. That's probably one key example, and I'm sorry to stray from bridging for a second, but it gives you kind of the feel for, you know, being able to help from the initial outset of acquisition, allowing them, as I mentioned before, the time to go through planning amendments and then the ability then to refinance through to development finance. So you've got that chain all the way through to, again, talking about the service element, holding the customer's hand, holding the broker's hand from cradle to grave, which is very, very important. So that is one key example for us. It allowed us then to transact in other areas of specialist finance, which again is lost on a lot of people sometimes, where, you know, your mindset is, right, I'm looking at an option, I've got a bridge, and then I've got to go and find someone else to do this part and someone else to do that part. If you can find a way where we can utilize the whole journey, that's important. That's one of the key examples for us. So yeah, purchasing a site allowed time in order to amend planning and then take them through that phase, uplift the value, and look at refinancing through development on the way out. Excellent example, thank you. Gareth?
So I've already alluded to one of the routes that we're seeing more and more of at this moment in time, which is that sort of 24-month facility where they're, you know, refinancing an existing buy-to-let property, giving them 24 months worth of grace where they're not having to meet a monthly payment because you looked at retained interest, and then you've given them that window of opportunity to ride out this higher interest rate environment. From that perspective, with the flexibility of being able to redeem at any point during that 24 months without penalty, so no, you know, additional incurring of costs. So again, I think it goes back to that buying time scenario.
Excellent, thank you. I'll throw one in that we recently completed on a regulated bridge. Clients, elderly couple living in a £500,000 house, just rattling around, kids had all moved out. They were looking to buy a retirement apartment. Everything was going nicely, got to the legal stage, and on the property they were selling, there's a boundary dispute with the next door neighbour, only a really small issue over a fence that was a couple of feet away from where it should be. All held up. The sale completely froze because they wanted to get this resolved first of all. The neighbour, again another elderly lady, wanted to transact by post with her solicitor. So this dispute that was something relatively simple was dragging on for months and months and months to get resolved. So we stepped in at the last minute to get a bridge to secure on the property they were selling in order to meet the completion deadline on the one they were buying. So that one came to us not even because they wanted a bridge to begin with, but because at the 11th hour there was a need for something to come out. It wasn't the smoothest of transactions because of all the legal issues in there, but we managed to get that resolved and get them to buy the property. So even if you're not looking at a bridge at the outlet, at the onset of the transaction, the opportunity could come along further down the line from there as well. Very quickly, just to finish off then, it seems to be an ever-changing market. Is bridging still something brokers should be looking at, and kind of where do you see things headed? Gareth, do you want to start us off with that one to finish up?
Wholeheartedly, I think it'd be foolish of a broker not to look at a tool that's there at their disposal that provides a solution, especially in today's environment. Whilst we see, a lot of moving goalposts in the financial world and the mortgage market as a whole. I think opening your eyes to those things that are slightly outside of the norm, but actually truly do provide solutions is a key element. There's a huge amount of opportunity to come, as I think Michael alluded to earlier. In an environment where things start to become a little bit tough, you might well see that properties come onto the marketplace. There'll be an element more of opportunistic purchases that can happen off the back of that. And then just thinking outside the box from a financial solution for a period of time to support a client in what their aspirations are. So, we're very positive around the bridging finance marketplace at this moment in time, because, again, the market doesn't often think, the mortgage market as a whole doesn't often think with common sense at this forefront of this thought process, whereas bridging finance is all about common sense.
Brilliant, thank you. Michael?
Yeah, agreed. Definitely brokers should be looking at bridging as an option. That shouldn't change. What tends to happen is when someone is not educated or understands what a bridging facility is, they tend to shy away from it. So, yourselves, Kris, and the guys at Crystal, provide that educational piece and understanding for those who don't know what a bridging loan is or how to use it or going down this route. It's very easy to shy away from something you don't know how it works or what it does or the implications of using it. So that is key in terms of providing that educational piece and making sure that people are utilising the product in the right way. And again, that for us is very, very important. And from a lender's perspective, and I'm sure Gareth's the same, we would never kind of shoehorn someone into something that doesn't work. And that's the piece that we can all educate ourselves in collectively and work harmoniously, making sure that we make the right decisions for our clients and our customers.
Brilliant. Thank you. So we've gone a little bit over time, but thank you for the questions that came in. They were certainly worth picking up on and talking about. It brings us to the end of another great session. So from me and on behalf of all of our attendees today, Gareth, Michael, thank you so much for lending us your expertise. And I hope that all the attendees found it as useful as I did. Some really interesting topics covered there.
Perfect. Thank you.
Thank you.
Thank you all. Have a good day.
Okay.
If you've got any cases that you'd want to talk through, or even any concepts that you want to talk about further, then please either give our mortgage desk a call on 01827 301070, or visit our website if you've got a case ready at crystalsf.com, and we're ready to help, and we can talk through any scenarios that you've got in front of you. I'm back on the 6th of December to talk buy to let in 2023 in our penultimate webinar. And Dan Morris is back on the 15th of December with the Complex Cases Christmas special with our resident tax advisor and chartered accountant, John McCaffrey. So from me, thank you for joining us today, and I hope to see you all again next time.